Hi accounting class, it's another great day to do accounting. Today we're going to be looking at exam number 3 practice problems. I'm excited for a lot of you because I know this will be your last exam. If you can get up to that 95 average on all 3 exams, this will be your last one. You'll finish the course with an A. So let's go and look at this. First, non-accounting majors can eliminate 2 of the problems by placing an X through them. You guys get to define whether you're an accounting or non-accounting major. I know the non-accounting one's going to be popular with this option. Alright, let's go and get to the problems. Problem number 1, straight line in units of production. We have a 10-year asset here. 123,000 initial cost. Purchased in the middle of the year on July 3rd. That's going to be a little bit of a problem for us in the first year. $8,000 residual. And it's expected to produce 92,000 units over its life. How much will be depreciated for each of the years? So, for the end of 2017. Alright, let's just remember the formula for straight line. It's the initial cost minus the residual value. So the initial cost minus the residual value divided by the number of useful life. So in this case 10 years. So 123,000 minus 8,000 divided by 10. And the first year is going to be a partial year. So we're going to have to adjust for it as well. See that part. Alright, so that's the basic formula for straight line. The next part is just for the fraction of the year. If we count this, January, February, March, April, May, June, that's 6 months. So we didn't have it for the first 6 months, but we're going to have it for the last 6 months. So we're going to multiply it by 6/12. Alright, for 2018 it's very simple. It's just this initial part here. It doesn't need the fraction of the year multiplier on it because it's going to be for a full year. Alright, under units of production, it's going to be very similar to straight line. All we're going to do is take cost minus residual. So cost minus residual. And then we're going to divide it, instead of by the 10, we're going to divide it by the 92,000 to get our rate. Once we have our rate, to apply the rate, we just figure out how many units were used, and you got 4,800 units times $1.25. That comes out to be totals up to $6,000. You don't need the fraction of the year multiplier, even though this is purchased at the middle of the year, because we're naturally going to use less units during the year if we purchase them in the middle of the year. So. Alright, double declining balance, $80,000 asset, 5-year asset, purchased on the beginning of the year. Okay, so it's a full year, that makes it easier. And we have a residual value of 10,000 at the end of its life. Calculate depreciation. We're going to leave this table in this problem, so we're going to look at the different attributes. We need to remember the book value is one of them, rate is this next column, and then the depreciation. Alright, the book value, this one starts off at 80,000. Remember, you do not take out the residual value here. That's one of the traps to this problem. It's not taking out that residual, so you don't want to take it out. So notice this is 80, not 70. The rate for this problem is always 2 divided by the useful life because it's at twice the straight line rate. So take the number 2 divided by, this case, 5. 2 divided by 5 is 40%, and that rate's the same rate throughout. Depreciation, now we just multiply across. Once we multiply across, we're going to take the prior balance minus the 32,000 and get the new book value. And then we're going to multiply across. We're going to take the prior book value minus the new depreciation. And we're going to multiply across. We're going to take the prior book value minus the new depreciation. We're going to multiply across. Alright. This last one, let's see where it's at. Now remember, we can't go below the residual value here. This is why we're going to have to reject this 40% rate. If you do the math, it's going to be depreciated by too much. So we have to reject the rate because we can't depreciate this asset below its residual value. So we're going to have this book value minus the 10,000. So if we take this number right here minus the 10,000, you get to 368. That's the most we can depreciate the asset for, because we cannot depreciate it below its residual value. Alright, selling fixed asset journal entries. This one's going to have an additional trick to it than what you saw on the quiz. The major difference here is we're going to record a partial year depreciation of 10,000. So you just need to remember the two accounts for depreciation is depreciation expense and accumulated depreciation. Alright, after you're done with that, what I'd kind of recommend doing is going back up here with the 90,000, crossing it out, and changing it to 100,000 because it's going to have effectively 100,000 accumulated depreciation after we record 10,000 more of accumulated depreciation right here. So I would cross this number out and write 100,000 effectively. Alright, so then other than that, it's going to be pretty simple. It's just like what we saw in the quiz. What we're going to do, we're going to take the equipment off our books. Alright, equipment's right here. We're going to take the equipment off at its original cost, 120,000. We're going to take the accumulated depreciation off the books. And remember, it's at 100,000, not at 90. There's accumulated depreciation. Yes, we're going to recognize the cash that was received. In this case, the first one is 10,000. Alright, now what do we have? We have 120 on this side, 110 on this side, so we need 10 more over here. That's why it's a loss. It's on the debit side, so it's a loss. Let's see about the next one. We're going to take the equipment off again. And we can go and recognize the cash that we received. We're receiving 20,000 in cash. We're going to take the equipment off at its original cost, 120,000. And we're going to take the accumulated depreciation off at 100,000. Notice there's no gain or loss here because it perfectly balances out. We got 120 here and 120 here. The last one, let's see the cash. They received 40,000 in cash. We're going to take the equipment off again at 120,000. We're going to take the accumulated depreciation off again at 100,000. And then we balance it out. There's 140,000 here, 120 on the credit side, so we need 20,000 more. And this time it's a gain because it's on the credit side. So it's a loss on sale of fixed asset. If it's on the debit side, it's a gain on the credit side. I'm okay with just the word loss and just the word gain. So you don't have to write out the full thing. I know what you're talking about if you call it a loss or a gain. But again, the major trick here is we are doing the 1 unit of depreciation. It gives you the number. So you just remember the accounts and then adjust the accumulated depreciation up here to be that much higher. So then we got to the 100,000 by taking the 90 plus the 10 equals the new 100,000. Then use that number in all your other entries. See how we took it off at 100, all of them. Alright, time value of money concepts to value a bond. We have a $100,000 bond, 5-year, 8% coupon, semi-annually. Market rate is 6%. Alright, we got small little tables here because that's all we need, so that makes it a little bit better. Total number of interest payments, the 5-year bond paying twice a year will be a total of 10 interest payments. 5 times 2 is 10. Cash interest payment, you just remember the formula. It's going to be the face value of the bonds times the coupon rate divided by the number of periods per year. So face value 100,000 times the coupon rate divided by 2. You get to 4,000. That's what they're going to make every 6 months. The market rate per period, which was called the discount rate, they mean the same thing, but the market rate per period will be the 6% divided by 2, because it's semi-annually, so 6 divided by 2 is 3. Present value of the face value. Alright, I switched these orders up, that way it's more rational. You're doing the face value one first, which uses the first table, and you're doing the present value of the interest payments, which uses the second table. So the present value of the face value is going to equal, it's going to be 100,000 times the present value factor, which we have to look up. We're going to look it up using the 3% and the 10 periods. So it's going to be this number right here, 0.74409. Finish. And I rounded it to the nearest dollar. For the present value of the interest payments, we're going to take the $4,000 that they're paying out every 6 months and value it with the annuity table, the second table, using these both the 10 and the 3. So it would be this number right here, 8.53023. Rounded. Alright, then present value of the bond is just the addition of the two numbers. In this case it's 108,530. If I change anything, it would probably just be the market rate. Probably change it to 4% or something. I just don't want students to remember it's this last box here, so it might be somewhere else. But you guys know how to get, it's just whatever you get here and here is what you plug into the tables. Alright, the next problem, this one's not going to be connected. Will not be connected to the previous problem, so they're going to be separate problems. Alright, let's go and get started. We're issuing $100,000 bonds, 5-year bonds, payable semi-annually for $4,000. The bond sold for $108, so they're giving us a number. And I know this one's connected right now, but it won't be. So I don't assume it's giving you the answer in the previous one. Alright, for the second entry, we're going to do the first interest payment. For the third, we're going to do the maturity date. Alright, so we're going to issue these at the start of the year. Alright, so we're going to collect cash equal to this amount they're giving us, the 108,530. We're going to recognize the bonds equal to 100,000. Put them on at face. They always go on at face, always come off at face. And then the rest is either going to be a premium or a discount. In this case, it's a premium because I need a number on the credit side to balance this. Alright. The next date, we're going to make the first interest payment. Alright, so we'll be paying out cash here. Let's go and go through the math. We're going to be paying out the face value times the coupon rate. Okay, never mind. They give you the number. We don't need the formula. They're giving you the number. I've written over it. Don't need it twice. Okay, so yeah, this problem is giving you the cash payment, so you don't even have to calculate it. This is mainly just a question over the journal entries. The other one was a question over the math of it, so I separated the two. So the cash is given. We need to amortize that premium, so we're going to take this number divided by the total number of periods. So we still need to figure out there's 10 total periods here. And we're going to take the amount of the premium divided by 10. And we're going to amortize it. That means it's going to be on the other side. This is on the credit side, so we're going to see 1/10 of that number on the debit side. And it will be to premium on bonds payable. Then interest expense would just be the number that balances it, so it would be 4,000 minus 853 equals 3,147. Alright, then the last one's simple. We're just going to pay off the bonds, so we're going to have cash leaving equal to the face value. And the bonds payable coming off the books. Alright, journal entries for dividends. This comes from Chapter 11. Assume a corporation declared a dividend of $92,500 on July 1st. The date of record was July 23rd, and the date of payment was August 14th. So you just need to know what these three dates are for dividends. The first day is the date of declaration, and here's the journal entry for it. What we're going to do is the date of declaration is when the board gets together and decides to have a dividend. So we're going to debit dividends. But they don't pay it on that date, so it goes into a dividends payable account. And they're giving us the amount of $92,500, so that's just the first entry on the date of declaration. Alright, for the second one, it's the date of record. The date of record determines if you're a shareholder and you own that stock on the date of record, you're going to be entitled to the dividend even if you sell it the next day. So these stocks are trading hands all the time. They're kind of like hot potatoes. Whoever owns on the date of record is going to get the dividend. After that date, it's said to be trading at X dividend. But for us, you don't need to know that. That's from an investor point of view. So for us, there's no entry. There's no journal entry. That's all you need to know. You skip that one. There's no entry. Now, on the next date, 14th, we're actually going to pay it. So we're going to have cash leaving of $92,500, and we're going to take that dividends payable off of our books, right? So we set it up here. On this date, we're paying it, so we're taking it off of our books. But those are the 3 ones for dividends. This should be a fairly simple one to do once we cover it in Chapter 11. Journalizing equity transactions, including treasury stock. Again, this is a Chapter 11 one. Alright, we sold 10,000 shares of $4 par common stock for $50,000. So the rule with common stock is we're going to record it, well, the cash will be equal to the 50,000. We're issuing the stock, so we're receiving 50,000 in cash. For common stock, we put it on our books at its par value, though. So we're going to put it on our books for 10,000 times 4, its par value. Common stock's an equity account, so it has a normal credit balance. So we're going to see this number on the credit side. Alright, now it doesn't balance though, but we record stock at its par value. So the 10,000 times the 4. And you're going to love the name of this next account. We put the rest into this account, additional paid-in capital in excess of par dash common. You can call it a PIC account if you want. PIC, I know you don't want to write that much, so just call it a PIC account. I'm just putting a long formal name here. The rest of it goes into a PIC account. So the rules with common stock or any equity, you issue it, you record it at its par value, and you put the rest into a PIC account if you receive more than the par value. Alright, next we're getting into something called treasury stock. If we buy back shares of our own stock, it's called treasury stock. Alright, treasury stock, method we're going to learn is cost method. So treasury stock will go on the books at cost and it will come off at cost. So in this case it'll be 1,000 times 6. And we're buying it, so we're paying out cash to do so. Alright, on the 30th, we sold 500 shares of those for $8 a piece. So we sold them, so we're going to collect cash. We're going to collect 500 times $8. Or 4,000. We need to take the treasury stock off of our books. We're going to take the treasury stock off at the cost that we put it on our books at $6. We're going to take it off at $6. So it'll be 500 times 6. Alright, this also doesn't balance, so we're going to need another account here. It's going to be paid-in capital from the sale of treasury stock. You can just do PIC-treasury stock if you wish. But the important rule with treasury stock, it goes on the books at cost, and if it comes off, it comes off at cost. Alright, we basically have the last problem here is the earnings per share problem. This is also from Chapter 11. This starts off with a number, if you get in finance, you're going to hear this number a lot. It's called EBIT, E-B-I-T. It stands for earnings before interest and taxes. This is our starting point for the calculation. Alright, and it gives us 120,000. Yep, given. The first thing we want to think about is the interest on the bonds. So these, we have 300,000 face value of bonds. They're paying 8%. So all we're going to do is multiply the 300,000 times the 8% to think about the interest. Alright, this is what we mean by interest being tax deductible, right? We get to take it out before we pay our taxes. So this is the first step, is to deduct the interest on the bonds. If we do that, we get to $96,000. Alright, the next step is to actually pay our taxes. So we've dealt with the 8% bonds, now we're going to pay taxes. So it's an order of operations. You do the interest first, taxes second, then you get your net income and calculate earnings per share. Income taxes, they give us the rate of 40%, so we're going to take this number times 40%. I'm going to show you a shortcut too, because we can effectively skip this step. We don't necessarily need this. We can actually go to this after tax or net income number. If we, instead of by 0.4, we multiply it by 0.6. The logic here is if we're going to pay the IRS 40% of our earnings, we're going to keep the other 60%. So you can go to this number times 0.6 and you get to the same thing, and you can skip this step if you wish. Alright, before we can calculate earnings per share, we need to know the number of shares of common stock. So the number of shares, the total amount is 420,000. And common stock, since it's issued at par, we can divide through by the par number and get to the number of shares. So it'll be 420,000 divided by 3. So 420,000, the total amount in common stock divided by the $3 par equals 140,000 shares. So you get earnings per share of 41 cents, and that's the answer. You can round this to the nearest penny. And just taking the net income divided by the number of shares that we calculated here. There will be 2 bonus problems. The effective interest method will be in Excel. I'll set up a template and send you, that way we can do 10 years and you guys can do it quick just by using the formulas. Statement of cash flow. Yeah, this will be pretty ambitious. I know we've had a hectic semester, so this should be your last priority. If you're feeling ambitious, you can pick up another 10 points here. It's going to be very similar to that first problem. I'm going to have a video uploaded on it, but again, this is your last priority. If you're picking up bonus, I would do the effective interest one first. And I would like accounting majors though to view at least the video and get some framework of the idea, because it is going to be an intermediate accounting, and it helps to kind of get ahead of the curve and build that framework before you get to intermediate accounting. Alright, but that's it for the exam number 3 review. Let me know if you have any questions, and I'll see you guys next time for the next video. Alright, bye-bye.